S3's FY26 half-year results just dropped, and they actually missed consensus pretty hard on the first half. Profit before tax plummeted 75% down to £2.7 million.
Yeah, it's a huge hit.
Right. Net fees dropped 7% to 147.7 million. And basic earnings per share, that fell to just 0.6 pence.
But, immediately following that drop, there's this massive counterbalance. Management actually reiterated their full-year guidance.
Which is wild.
Right. They still expect FY26 profit before tax to hit consensus at roughly £10 million. And on top of that, they're holding their interim dividend completely steady at 5.1 pence.
And they're continuing the £20 million share buyback program, too.
Exactly. Which projects just supreme confidence from the board.
It sets up this incredible tension, because if you're a retail investor, you look at a 75% cratering of the bottom line, and you instinctively just hit the panic button.
You assume the floor fell out of the business model.
Yeah. But maintaining guidance, paying out the dividend, aggressively buying back shares, it means we really need to look at how this works. So for this deep dive, our mission is straightforward. How does a global STEM staffing firm absorb a hit like that in the first half and just not flinch?
We got to unpack the underlying mechanics here.
Right. Their revenue, their margin defenses, the cost cutting. We need to see if this optimism actually holds up or if they're just crossing their fingers for a miraculous fourth quarter.
Well, to understand where that confidence comes from, we have to really pull apart that 7% drop in net fees.
Because it's not a uniform drop.
Not at all. When you look at the geographic breakdown, it is very much a tale of two hemispheres right now.
Yeah, I noticed that glaring regional divergence immediately. But real quick, for anyone listening who might be newer to staffing industry metrics, let's clarify net fees. We're basically looking at their gross profit here, right?
Exactly.
It's the actual revenue S3 keeps after they pay the contractor, rather than the total gross billing that just passes through their accounts.
That's a critical distinction to make.
Yeah.
Net fees are the value the firm actually generates for itself. And when you look at where those fees are coming from globally, the U.S. market is the clear engine pulling the train here.
Because they grew there.
Right. They managed to grow net fees in the U.S. by 12% year over year, which is just a robust number in this macroeconomic climate.
Seriously.
But that U.S. performance is essentially acting as a massive counterbalance to Europe, which is just dragging the top line down significantly.
Yeah, the European numbers look incredibly rough. What exactly is happening in the DACH region? So that's Germany, Austria, Switzerland. That segment is down 15%.
Well, the DACH region is highly exposed to industrial and manufacturing cycles, particularly in Germany, which has been facing severe macroeconomic headwinds, energy cost realignments. Enterprise hesitation there is just acute.
And it's not just DACH, though, is it?
No. The Netherlands and Spain combined, they're down 19%. And the rest of Europe is down 14%. When you have corporations uncertain about the next 12 months of GDP growth in Europe, the immediate reaction is to just freeze major new project spending.
Right. I do see the Middle East and Asia provided a little bit of a bright spot, up 16%. But the U.S. really is the heavyweight doing the work here.
It really is. The U.S. makes up 32% of their total net fees. So, generating 12% growth in a region that accounts for a third of the business that's doing a tremendous amount of heavy lifting to offset the softness in DACH, which is about 28% of their business.
Makes sense. The U.S. labor market has just remained way more dynamic.
Exactly. U.S. enterprises have been way quicker to adopt flexible, project-based labor for their STEM needs compared to the more rigidly regulated European labor markets.
So that actually brings up a fascinating contradiction to me. When you cross-reference those regional numbers with the actual skills and sectors S3 is recruiting for, I start to have some real questions.
Oh, about the tech sector?
Yeah. Let's look at the sector performance. Engineering was essentially flat, down 1%. Life sciences fell 8%. But technology, their tech segment, was down 14%.
Right.
Now, S3's own presentation explicitly cites, quote, AI and data centers and AI adoption, compute, and cloud infrastructure as the structural, multi-year megatrends driving their success.
They do lean heavily into that narrative.
So if AI is this massive, unstoppable megatrend that literally every company on Earth is supposedly investing in right now, how on earth is their technology segment down 14%? Are we seeing a massive lag in European tech adoption, or is the macro environment just completely overpowering the AI hype?
It's the macro environment overpowering the immediate micro trend. And I think it really exposes the gap between corporate ambition and actual capital deployment.
Okay, how so?
Well, the structural demand for AI and data centers is very real. S3 actually highlights a great case study in their materials where they rapidly built a fully compliant project team for a major hyperscale data center program.
Oh, right, because the client couldn't navigate the STEM skills shortage in a highly regulated market on their own.
Exactly. So the underlying demand for those highly specific skills definitely exists
But if the demand exists, why the 14% contraction?
because of the cost of capital and just broad enterprise uncertainty. I mean, while every CIO out there wants to implement AI, enterprise spend on broader tech projects, especially in Europe, has tightened up considerably.
So they're just talking about it, not spending on it.
They're doing small proof-of-concept AI pilots, and those don't require hundreds of external contractors. They're hesitating on pulling the trigger on the massive multi-million-dollar broad technology deployments that actually move the needle for a firm like S3.
I see.
So the long-term trajectory for tech skills is up, obviously, but the short-term reality is that enterprise IT budgets are under severe scrutiny.
Okay, so the top line revenue is absolutely being pressured by this European softness and broad enterprise hesitation. But I guess this brings us to the core of how they survived this first half without totally collapsing their margins.
Right, the shock absorber.
Yeah, if the top line is taking a hit, their specific contracting model seems to be saving them.
And this is where we really have to transition from looking at what kind of skills they sell to how they actually structure the sale. You really have to understand their contract-led strategy.
Okay, walk us through it.
Currently, 85% of S3's net fees are derived from contract work. Only 15% comes from permanent placements.
Which is a massive distinction during a downturn. Traditional recruitment firms that rely heavily on permanent placements get absolutely slaughtered during macroeconomic tightening.
Oh, completely.
Permanent hiring is the very first thing a corporation freezes when they're worried about the next quarter. But 85% contract work provides this built-in layer of resilience.
Yeah, because a company might freeze its permanent headcount, right? But they still have regulatory deadlines to meet, or pipelines to upgrade, or data centers to finish building.
So they bring in contractors on operational expenditure budgets rather than expanding their permanent payroll.
Exactly. That's the defensive nature of contract work. But S3 actually takes it a crucial step further, and this is the true margin defense mechanism we need to look at. It's called the Employed Contractor Model, or ECM.
The presentation leans super heavily into ECM. It now makes up 43% of their total net fees. And back in FY19, pre-pandemic, it was only 22%.
Right, they've almost doubled its share of the business over the last few years.
And what's the financial impact of that shift?
It is the single most important metric for understanding their resilience. ECM generates 30% to 40% higher net fee margins compared to just placing independent contractors.
30 to 40% higher.
Yeah. Because of this intentional structural shift toward the ECM model, S3 actually managed to tick their overall contract margin up by 0.2 percentage points to 21.7% for the half.
So their total revenue was falling, but the profitability of the revenue they did keep actually went up. Wait, so if I'm understanding this, an independent contractor model is essentially like being a real estate broker. S3 introduces an independent STEM contractor to a client. They take a finder's fee or a thin margin on the hourly rate and then kind of step back.
Right, that's the traditional way.
But with ECM, S3 is acting more like the general contractor on a major commercial build. Like they actually legally employ the workers.
That is a perfect way to visualize it. Under the employed contractor model, S3 becomes the legal employer of record. They take on the immense burden of global employment logistics.
Meaning they handle the payroll, local tax compliance, benefits, visas, all that localized HR stuff.
All of it. Which, if you are a multinational corporation trying to hire a specialized cloud architect who lives in Spain for a 12-month project in Germany.
Oh, the cross-border compliance of that is a total nightmare.
It really is. It is increasingly difficult for enterprises to manage that across different international jurisdictions. So by taking on all that heavy lifting and regulatory complexity for the client, by acting as that general contractor, S3 commands that massive 30% to 40% premium.
And I imagine it builds a huge moat, too. Smaller, localized staffing firms simply do not have the balance sheet or the legal infrastructure to offer a multi-country ECM.
They don't. It's a huge competitive advantage.
Okay, that makes sense. The margins are heavily defended by this ECM premium, but that brings us to the elephant in the room regarding profitability.
The operating profit drop.
Yeah. If margins are so well protected and the ECM model is highly profitable, why did their reported operating profit fall 67% down to £3.4 million? That is a steep drop.
It is. But this is where we have to bridge the gap between the reported statutory numbers and the underlying health of the business. You really have to strip out the non-recurring costs to see the actual run rate.
Okay, so what did they spend on?
Well, S3 executed a planned cost optimization program in the first half. When you add back those £6.4 million in non-recurring restructuring costs, their underlying operating profit is actually £9.8 million.
Oh, wow. Which changes the narrative completely. 9.8 million underlying operating profit is virtually flat compared to last year's 10.0 million.
Exactly. The core business profitability held up remarkably well. The $3.4 million reported figure includes the one-off pain of restructuring and severance.
But the 9.8 million shows what the business actually generated from its operations.
Right.
Well, let's dig into that restructuring and cost discipline then, because the numbers there are aggressive. Total headcount is down 15% year over year. They are now sitting at 2,150 full-time employees.
Yeah, it's a significant cut.
So my immediate pushback here, playing devil's advocate, are they genuinely achieving tech-driven scale? Like, are they truly figuring out how to do more with less? Or are they just slashing headcount to protect the dividend and fund the share buyback, risking complete staff burnout and a total lack of capacity when the European market eventually rebounds?
It's the right question to ask. Whenever you see a 15% headcount reduction in a relationship-driven business like staffing.
Because normally that means they're cutting to the bone.
Right. But S3's internal data suggests this is a genuine structural efficiency play driven by technology, rather than just desperate cost-cutting.
What technology?
They have been rolling out their technology improvement program. They call it TTIP. And the operational metrics they are reporting off the back of TIP are frankly staggering. Compared to their pre-TIP baseline back in the first half of FY23, their consultants are booking 69% more client meetings.
69% more meetings. That means the back office automation must actually be working.
Exactly.
If consultants are spending that much more time face-to-face or on the phone with clients, they aren't bogged down in administrative formatting or manual data entry.
That is the whole goal of the platform.
Yeah.
And it gets more specific. They report sourcing 41% more what they term A-grade jobs per consultant.
Yeah, the presentation mentions these A-grade jobs several times. What does that actually mean on the ground for a recruiter? Is the software just filtering out dead-end leads so they don't waste their time?
Essentially, yes. An A-grade job is a high-quality, high-probability conversion vacancy. The technology platform uses predictive matching and better data filtering to score the leads.
So instead of a consultant chasing 10 mediocre job postings with a low likelihood of a placement?
The system surfaces the 3 jobs where S3 already has the perfect candidates in their database, and the client has a history of fast hiring.
Oh, that's smart.
Because the consultants are focused on these optimized leads, placements per consultant are actually up 6%, and the time to placement, the speed at which they fill the role, is a full day faster.
So they are actively decoupling their net fee generation from their back office headcount costs.
Exactly.
That perfectly explains how overall productivity, which they calculate as net fees per employee, is up 9% versus last year. I mean, they took 15% of the human headcount out of the business, but top-line net fees only dropped 7%.
And the remaining consultants are significantly more productive because the tech is doing the heavy lifting on the sourcing side.
Plus, they centralized a bunch of stuff, right?
Yeah, that unified tech platform allows them to centralize their global operations. They highlighted creating a leaner transactional base at their Glasgow Center of Excellence.
Right.
They're standardizing all these complex ECM processes globally, so as the market eventually turns and revenue grows, they can scale up operations without having to hire operational staff at the exact same rate.
Which brings us to the forward indicators. Management claims they have, quote, cautious optimism for the second half of the year. Now, a lot of management teams say cautious optimism when they are secretly terrified about the next 2 quarters.
Oh, all the time.
But S3 actually backed that phrase up with a hard forward-looking metric.
They did, and it revolves around the contractor order book.
Now, for a staffing firm, this is the holy grail of financial visibility.
Explain that for us. The contractor order book represents the total value of net fees locked in until the contractual end dates of their current placements, assuming all contracted hours are actually worked. And crucially, that order book has returned to growth.
Nice.
It is up 3% year over year, sitting at £152.2 million.
That 152.2 million figure is just massive context. That is the equivalent of roughly 5 months of net fees already locked into the system before they even make a single new placement.
Contrast that with a traditional permanent placement firm. They start every single quarter at zero.
Yeah.
They wake up on day one of Q3 wondering if the phone will ring and if companies are hiring. SThree wakes up with 5 months of revenue visibility already on the books.
That is the ultimate validation of moving to an 85% contract-led model.
And furthermore, the average contract length is holding incredibly steady at 58 weeks. They are seeing stable new business activity year over year, and they actually delivered growth in the order book across 6 distinct countries.
So when management reiterates their full-year guidance of roughly £10 million in profit before tax, they aren't just crossing their fingers and guessing.
Oh.
They are looking directly at that £152 million order book. It is largely a mathematical extrapolation of the contracts they have already signed and the hours that are scheduled to be worked.
That's the core of it. It's highly predictable revenue.
Yeah.
But, the kicker here is that the benefits of their cost optimization program, that 15% headcount reduction and the tech efficiencies, those are heavily weighted to the second half of the year.
Oh, I see.
So the second half will benefit simultaneously from a growing revenue order book and a significantly lower fixed cost base.
Let's pivot to the balance sheet to wrap up the financial picture, because maintaining a dividend and funding contractor payrolls ahead of time requires serious cash.
It really does.
If their reported profits are down, how are they actually paying for all of this? Liquidity is the ultimate safety net here. They ended the half with a net cash position of £43.0 million. Now, that is down from $68.0 million at the same time last year. But looking at the mechanics of the business, that cash burn makes sense, doesn't it?
The decrease in net cash is entirely logical when you look at the working capital cycle of their specific model.
Right.
It's driven by 2 main factors. First, obviously, is the lower underlying cash generation due to the reduced reported operating profit we discussed earlier. But the second, and more important factor, is increased working capital investment.
Because of the ECM growth.
Exactly. When you grow the employed contractor model, especially in a fast-moving market like the U.S., you have to fund the contractor payroll on a weekly or biweekly basis, long before the enterprise client actually pays your invoice on net 60 or net 90 terms.
Right. So as the ECM book grows, they are essentially floating the payroll for these massive enterprises.
Yes. So you see a £24.2 million net decrease in trade debtors and accrued income, balanced against decreases in payables. It simply takes capital to fund a growing ECM contract book.
But even with that working capital requirement, beyond the $43 million in hard cash, they have significant backup liquidity.
They do.
They have a completely undrawn £50 million revolving credit facility, a £5 million overdraft facility, and they mention a £30 million accordion. Now, for the listener who might not be a corporate treasurer dealing with commercial debt every day, what exactly is an accordion facility in this context?
An accordion facility is simply an option built into their credit agreement that allows them to expand their line of credit by an additional £30 million if they need it. And usually, that's under the same terms as the original revolver.
Okay.
It gives them the flexibility to increase their borrowing capacity quickly if, for example, they land a massive new global client and need immediate capital to fund the initial ECM payroll float.
Got it. So between the cash, the revolver, and the accordion, the balance sheet is fundamentally, undeniably sound.
And that completely explains their capital allocation strategy. I mean, you do not maintain a 5.1 pence dividend, and you certainly don't aggressively execute a £20 million share buyback if you are even slightly worried about liquidity.
Right.
They are generating free cash flow, they have a massive cash cushion, and clearly the board believes their stock is undervalued relative to the long-term cash generation power of that £152 million contractor order book.
Which leaves us with a broader macro question to mull over as we look at the entire landscape. You look at SThree pushing 85% of its business into flexible, high-margin contract work, with nearly half of that in the highly complex employed contractor model where they act as the legal employer of record.
Yeah.
Are we seeing a permanent structural shift in the global labor market?
I think it's a compelling thesis. I mean, as corporations globally face unending macroeconomic anxiety, geopolitical stress, and rapid technological shifts where skills become obsolete every 3 years, enterprises are just deeply hesitant to commit to permanent headcount.
Yeah, that makes total sense.
Flexibility isn't just a reaction to a downturn anymore. It's becoming the baseline mandate for how enterprises want to operate.
Exactly. SThree's model might not just be a defensive staffing strategy for a cyclical European downturn. By building the tech platform to take on the global compliance, the payroll float, and the cross-border HR risk, S3 might literally be writing the blueprint for the infrastructure layer of the future STEM workforce.
That's entirely possible.
If companies only want to rent talent rather than buy it, the firm that makes renting seamless captures all the value.
And that £152 million order book suggests the enterprises are more than willing to pay the premium for that seamlessness.
It is definitely something to keep a close eye on over the next few quarters as we see if the U.S. continues to pull the weight or if Europe finally stabilizes. That is it for our deep dive into S3's first half results. For daily, no-nonsense earnings coverage and a relentless focus on the mechanical numbers that actually matter to the underlying business, make sure you follow the show. We'll see you next time.